Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of PCBL hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanjesh Jain from ICICI Securities. Thank you and over to you, sir.
Thanks, Michelle. Good afternoon, everyone. Thank you for joining on for PCBL Limited Q1 FY23 results conference call. We have PCBL management on call represented by Mr. Kaushik Roy, Managing Director, Mr. Raj Gupta, Chief Financial Officer, Mr. B.L. Chandak, Executive Director, Mr. Pankaj Kedia, Vice President, Investor Relations. I would like to invite Mr. Chandak to initiate the call with his opening remark, post which we can have a Q&A session. Over to you, Chandak.
Yeah, thank you, Sanjay. Good afternoon, ladies and gentlemen, and very warm welcome to all of you. I will quickly take you through the company update and then open for questions thereafter. Operating and financial performance for Q1 FY23 is already PCBL reported strong operating and financial performance in this last quarter. PCBL reported sales volume of 109,377 metric ton during the quarter. This was with strong domestic sales volume of 77,097 metric ton and international volume also picked up to the extent of 32,280 metric ton. If we look at segment-wise, tire accounted for 77,650 metric ton. Performance chemical reported sale volume of 21,860 metric ton and specialty black sales volume of 9,867 metric ton. Our revenue increased on year-on-year from 1,004 crore to 1,409 crore in Q1 FY23. EBITDA increased by 27% to 205 crore year-on-year. EBITDA per metric ton stood at 18,832. Sales stood at 126 crore, jump of 21% on year-on-year. Power generation increased to 144 million units during the quarter with external sale volume of 86 million units. With rising demand for power in the country and consequent increase in power tariffs, PCBL's average realization against power sales saw a sharp jump from rupees 2.65 per kilowatt of unit to rupees 4.06 per kilowatt of unit year-on-year. In FY22, we had added 2 more CPPs totaling around 15 megawatt capacity in Mundra and Palej. That also helped us to have increased volume. Despite steep increase in crude prices, EBITDA per metric ton improved on the back of conducive demand-supply scenario and improved performance from power and specialty volume. Now I request Kaushik Roy, our Managing Director, to give you outlook on current market scenario and in the remaining quarters of the year.
Hi, good afternoon everyone. Kaushik Roy here. Thank you, Mr. Chandak, for updating on the numbers. I'll talk a little bit about last quarter's scenario and how it's looking like at this point of time and what is our feel going forward. Last quarter, as you know, initially what we thought that because of this conflict between Ukraine and Russia, there is kind of opportunity for organizations like us because Russian supply was kind of restricted to the rest of the world. And that was actually the case. Eventually, as the war continued, the high level of inflation now persisting for quite long because of price increase because of the war. And consequently, what we see now that demand cycle has started getting impacted a bit globally. As you all know that in USA, today the percentage of inflation percentage is about 9%. I'm talking about the month of June, and Europe also close to that, 8.6%. Now, in this geography, such kind of high inflation is almost like unheard of kind of situation. And since these are big consuming geographies, economies, so therefore it is bound to impact the demand on overall basis for the entire globe. The Indian scenario on the upside is close to again 7% inflation, but India as a country has seen similar kind of inflation in the past. Ability to manage that kind of inflation is slightly better compared to the world. But as I also said that India is today part of the integrated global market. So therefore at some point of time, India will also start getting impacted, and we have already started feeling the same thing in this quarter. So the point I'm trying to make that last quarter we got some advantage and we spotted some opportunities because of impact on Russian supply. But slowly the situation is reversing now because of persistent high inflation coupled with high interest in many countries. And we are seeing that overall demand globally is coming down. So that's a bit of a botheration for us at this point of time. We need to find solutions for this. We need to be extremely agile to look at our ability to move from one geography to another geography, keeping in mind the demand scenario in different geographies. We need to be extremely agile in terms of our product portfolio, moving between tires and performance chemicals and specialty chemicals, of course, is kind of standalone. So the ability has to be very high, the agility has to be very high in that area as well. So these are the situations we are facing in recent time. Last quarter was good. This quarter so far is looking all right. It is under control. In India, automobile industry is doing more or less decently. There is no sharp growth, but it is more or less steady at this point of time. Tire companies were facing a bit of a problem because of the high raw material costs and their inability to pass it on to their customers. So they were facing some challenges, but they are also quite optimistic. We have been talking to some of them. They are also quite optimistic that going forward, crude situation will improve and consequently the cost structure will be much more conducive, and that will help their cause, and of course, which in turn will help our cause as well. As you all know that currently our portfolio, we are happy to say about 64-65% is tire and rest is between performance chemicals and specialty chemicals. So I would say as an organization, we have been working on this portfolio for quite some time through our R&D initiative, and over a period of time we could manage to bring some kind of balance. We are not too dependent on any particular segment. It is very well arranged. So therefore the level of confidence that going forward also will be able to manage the show is quite high in the organization as a whole. Talking about our focus area as an organization, I'll highlight some of the points which are critical for us as an organization. We feel that we are on a very strong wicket to look for a very fast growth, and in line with that, as you all know, that we are coming up with Greenfield Chennai plant, which is likely to go on stream by end of this calendar year, December 22. Our target date for commissioning. Give and take, we are more on time. There are some external factors which are influencing the progress, but broadly it is under control, and we are hopeful that by end of this calendar year we will be ready to commission the plant, and thereafter some time will be required for stabilization, take care of the teething problems, trials with our customers, and eventually it should be running commercially at full fledged. So that is on the greenfield side. On the brownfield side, as part of our first growth strategy, Mundra expansion for specialty is going on. Phase 1 of that is going on right now. So out of 2 lines, 1 line is under construction at this point of time, and we are expecting that the line will be ready for commissioning by end of March 2023, which is financial year 23 end actually. And thereafter, whatever time is required for trials and all, that will be needed. With this, the capacity of facility also will go up from a level of 72,000 currently, and after phase 1 and phase 2 of Mundra, it will become 112,000. Our current power capacity is 91 megawatt. Another 7 megawatt power plant is under construction at this point of time in Kochi, which should be ready in another couple of months' time for commissioning. That will take the power capacity to 98 megawatt. The second strategy, first growth I talked about, the second strategy is specialty chemicals, the focus for the organization on the specialty chemicals. I talked about the growth, which is through the brownfield in Mundra currently, and we'll be looking for further opportunities. But the bigger focus area for specialty today is initiatives through research and development. We have two research and development centers, as all of you know, one in India, outside of Baroda, and one in Belgium, outside of Brussels. And between these two R&D centers and technology team, we have roughly about 60 scientists and engineers and chemists. They are working, coming out with newer products, newer technologies for processing, and some fundamental initiatives. And also we are working on usage of raw material, usage of oil, varied kind of oil for different applications. So the second focus area, as I said, as an organization, is the specialty chemical area. Third one is international market. As we are adding capacity, it is also important that we spread our wings adequately. Currently, we are roughly doing about close to 30% of our production is going outside of India in international markets. We are representing a number of countries across the geographies. And as with time, we will be increasing this trade further. We'll be going further up in terms of our trade. And therefore, we are focusing a lot in international market on the service network, on putting the supply chain block across the world in terms of having, say, warehousing system, in terms of having decanting system, and so on, so that we can supply to our customers on time, just-in-time kind of delivery mode we can adopt. That is the objective. And suppliers feels like it's a virtual plant supply. Our manufacturing unit is not there, but our product is available next door, so it gives a feeling of virtual plant. And third is the international market. We are focusing a lot on people leadership. In two areas particularly, one is on the technological area. We will have our own people from those countries, and they can connect with the customers, connect with them in their own language. They can converse with their people, those people in their own language. And the second area is people from the sales and marketing side. So on the people leadership side, on the international market, we are focusing on technological side and sales and marketing side. The fourth focus area for the organization is digitization. Now, when I talk about digitization, we started taking some baby steps a few years back in different areas, different functions. So, things like document management system, things like production planning, automated production planning, things like managing documents of export and import. These are already done. But this was not really a comprehensive approach. It was more like looking at different processes and trying to make them automated and make them more efficient, which we are going on. But I think as an organization, the first major comprehensive target what we took is putting this Chennai plant as per Industry 4.0 standard. As I mentioned last time also, Industry 4.0 is the latest standard of manufacturing globally. It actually means it is a closed loop feedback system, which is a system we will pick up feedback from the running plant, and in case there is some problem in the running condition, it will quickly analyze and through the control system that problem will be sorted out. The closed loop feedback system and the analysis is being done through artificial intelligence and data analytics. We are hopeful that this will lead to benefit in terms of profitability, because we'll be able to manage our quality system better. We'll be able to improve reliability of our plant. We'll be able to possibly improve productivity and yield as well. But these are expectations, and based on calculations on the paper, we feel it is possible. We will really get to have the feel once the plant is commissioned and stabilized, and then we'll see over a period of time how much benefit is coming to us. And once we are sure about the benefit of Industry 4.0, we will horizontally deploy it in our other plants. So that is primarily a major focus area for us as of today from digitization point of view. Industry 4.0 for manufacturing, and manufacturing being the backbone, you can understand this is the most critical journey from our point of view as far as digitization is concerned. And another critical focus area for us, and the final one from my side, is ESG and sustainability. I think as a responsible organization, as a responsible corporate, this is one initiative we needed to take. We started this journey about 3 years back. We took some baby steps, very small steps we had taken. But now I think that it has picked up that wing. We have collaborated with one of the leading consultants in the country, and we have identified material topics to work on. We have taken defined targets, within a defined timeline for achievement to be achieved. And our second sustainability report was issued about 4-5 months back. It's posted on our website also. In case any of you want to see, you can definitely have a look. So this is about the focus areas of the organization. We will continue to grow. That is the primary thing. We will continue to focus on the portfolio, more focus on R&D driven, specialty side, as I said, international market, digitization, and finally ESG and sustainability. So with this, I will open the session for Q&A, and let's go for it.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment for the question queue assembles. The first question is from the line of Aditya Khetan for SMIFS Limited. Please go ahead.
Yeah, thank you for the opportunity. So my first question is on the China part. So what is the current situation in China? Like that, so that 2 million ton of shutdown in China, is still a continuing problem or the capacity has coming back?
There is no major change per se in terms of Chinese capacity. I think you are aware of that over a period of last few years because of different reasons. One reason is raw material availability, and another reason was environmental challenges. A lot of consolidation happened in China in power industry, like many other industries in China. And consequently, as we understand, but there is no official report on this, let me qualify here. As we understand, almost 25-30% of the capacity is actually not available for production today. And to our understanding, the situation remains more or less same. We also understand, in addition to that, there is further lack of availability of raw material. There is further issue in terms of availability of raw material. So that is causing further pain for them, and their raw material prices have also gone up substantially. So some of the players over there, they are trying to see if they can switch from CBO to coal-based oil to crude-based oil. That's what their target is. Some of them are working, I believe, on that. That's the situation of China. So there is no major change in terms of supply side from China.
Sir, I would request you to repeat the last line as there was a static and we couldn't hear you. Could you please repeat your last line, sir?
Last line, what I said that in view of this, what we feel that there's no major change from the point of view of supply side from China.
Okay, sir, got it. Sir, just a follow-up on this. So definitely, so the current carbon black prices of 125 per kilo globally. So this is definitely factoring in the China shutdown issue. So consider that if the crude prices so tomorrow falls by roughly around 20-25%, still we can make a case that the carbon black so prices wouldn't fall to that extent.
Sorry, we are not able to follow you. There's some problem with the sound. Just hold on. There's some problem. We're not able to follow you really properly.
Mr. Kiran, I would request you to ask your question on a handset as your voice is echoing. Could you please do that?
Is this audible, ma'am?
Yes, it is audible. You can...
Yeah, that's correct.
Yes, yes. Sir, I was asking into the China part. So consider that tomorrow is the crude prices fall by roughly 20-25%. Now considering the Chinese capacity that still constrained, so can we make a case that the carbon black prices wouldn't fall to that extent and they could stabilize somewhere around 110 to 115 rupees per kilo? So considering if the crude prices fall by 20% and carbon black prices wouldn't fall to that extent, can we make a case considering that the China shutdown which is going on?
I think what you are saying is a kind of hypothesis. It cannot be directly linked to raw material price or something like that because there is also something called supply-demand situation in the market. So
Yes, sir.
Product is also driven by supply-demand situation in the market. Of course, cost does play a role, but that cannot be the final deciding factor. So it is a very hypothetical question, I will say. So can't really put a figure, but of course, if cost comes down, there will be some reflection of that on the price of carbon black for sure. But again, there is another major factor, a parameter, which is supply-demand. So at that point of time, what is the supply-demand situation? We need to keep that in mind as well. So that's what I would say to your question.
Okay, sir. Then my second question is on the spread part. And in this quarter, we had the highest ever spread of 35 rupees per kilo. Now, definitely this is led by the higher realization of carbon black, but similar rise we had not seen into the carbon black feedstock prices. So can we say that so we have stocked the carbon black feedstock inventory at lower levels, so this has benefited in this quarter?
Sir, you are not audible.
You will have to repeat your question. We could not hear you properly.
Mr.
That is
Kiran,
my
your voice is echoing. We cannot understand what you're saying. I would request you to reduce the volume of your phone a little bit and then speak. Because
I'm joining the back again.
Okay, sir.
I'll join
Thank you so much. The next question is from the line of Dhaval Shah from Girik Capital. Please go ahead.
Yeah. Hello, team. Great set of numbers. Sir, my only one question. So our spreads and our EBITDA per ton has been one of the best in the last 4 years. I would like to understand, this is our last con call, we did not expect such great improvement in the performance in this quarter. So has there been any sort of one-off or what has led to this massive expansion in our spreads in EBITDA per kg? Thank you.
I'll request Mr. Raj, our CFO, to respond to your question.
Sure.
The voice quality actually is still not good, so we can't properly. But if my understanding is correct, you're asking the current margin profile, whether these are sustainable. Is that your question?
Yeah. So because in last, I was just looking at numbers in last 5 years, we've never done such high EBITDA per kilo or gross profit per kilo. This is our last con call. So we did not feel any sort of, large increase in spread which would lead to such high profitability. So is there any one-off item in the current quarter which has led to such high profitability, would just like to understand more that, where the such great strong numbers has come from and how do you see them going forward?
Well, there is no one-off item as such, but like Mr. Roy was talking about tight supply situation currently on back of this Eastern European geopolitical crisis. So there was an opportunity in the market, and we are a very agile organization, and if there is an opportunity, we ensure that we utilize it. So the current quarter margins are more reflective of a short-term opportunity in the market. Our long-term guidance remains in line with what we had communicated last quarter, that whatever improvement happens, that will be more gradual, and that will reflect more gradually over a period of next 4-5 years because of better operating leverage, because of better operating efficiencies, and also because of product portfolio improving. So these kind of margins are kind of reflective of immediate opportunity in the market. I would not say you should take these margins as this.
Understood. So now, if the geopolitical problem has given us a benefit, was there benefit in the spot prices in the domestic market or export? Because our export volumes are at a 4-quarter or 5-quarter low right now for the Q1 23. So we gained on pricing in that quarter, in the export market, or we gained in pricing in the domestic market?
See, it is ultimately global market, right? I'm not saying that we are selling more in global market, but I'm saying because the market is global, so when price increase in one market, automatically it also reflects on pricing in the other market. And generally the profile of margin change, pricing and margin both changes. Right? So it does impact when global market margins are better, or the realization is better. Typically domestic market margins also improve with that. So it's all around, I think, good situation. What was there in the previous quarter last time.
Gotcha. And as we speak today, how is the situation? Is it similar to the last quarter, or all those short-term opportunities are gone?
I would say, we don't give any forward guidance. I would say that it is an extremely volatile and uncertain market. So it is one day at a time, but we can only give you assurance that we are a very agile organization. In past also, we have withstood a lot of headwinds. Most of the situation created by pandemic, geopolitical crisis and all, and we don't get overwhelmed by any situation. So if there are headwinds, we will ensure that we withstand that, and if there are tailwinds, then we ensure that we take advantage from the opportunity.
Okay. Yeah. And sir, now, given crude has started correcting, I would not say falling, so do you, historically, have you seen that when the crude starts falling, correcting, the customers become little cautious in their purchase because now the prices are on a downward trend, the raw material prices are on a downward trend. How is the customer behavior?
You're right. If goods are falling, naturally customers will eventually expect that there will be a correction in the price, and therefore chances are high what you are saying cannot be ruled out. But sometimes as Mr. Rajgupta was saying just now, it is more about our agility, the ability to move from one product to another product, one geography to another geography, one customer to another customer, shifting volume depending on the spot opportunity. So we have to be extremely agile to counter those kind of things. These are normal things, part of any business. It is nothing unusual. So if we stay agile, if we stay focused and continuously analyze and scan the situation, I'm sure we'll be able to find out solutions for this.
Okay. And sir, this drop in oil prices would have definitely also led to drop in our raw material prices. So, and it will reflect with a lag in our P&L. So, is there a fall which is happening in our carbon black feedstock? And by when do you see, if it stays at current level, in which quarter will we see the impact?
See which impact?
The fall in the CFS, the carbon black feedstock raw material. So the fall in the prices with the fall in the oil prices, has it happened? And if yes, then in which quarter shall we see the impact of that?
In fact, in terms of cost reduction, you're saying?
Yes, the raw material cost reduction.
Well, I mean, I'll say one thing here. In between, oil was at about 120 plus level per barrel. Brent oil, I'm talking about crude. It came down below 100 at one point. It was 97 or 95 Brent came down to, and there was expectation when Mr. Biden, the American president, he was visiting Saudi Arabia, that Saudi Arabia will improve, or Saudi Arabia will increase production of oil, and consequently the oil price will go down further. But unfortunately, Mr. Biden could not get any commitment from Saudi Arabia for increase of production. Okay? And what happened after that? Immediately the oil prices went up again. Today, as we speak, it is roughly around, yesterday it was about 107 per barrel, the Brent price. So it is quite volatile, and it's a couple of days it is coming down and then again it's going back. It may not reflect that much in our buying. But if the trend-wise it is downward, of course it will reflect typically after 2 to 3 months' time. Typically.
Okay.
That's the kind of lead time, because oil primarily we buy from US, as you know, there is a lead time, there is a selling time, there is a storage, all those things are involved. So typically it is 2 to 3 months' time. But every small up and down, so it is difficult to capture that.
Okay. Understood, sir. And how is the freight cost? Do you see any reduction there? Because that was also troubling us.
Freight cost reduction, well, as of today, I would say that the continuous upward movement, what we had seen a couple of quarters back, that has become a little bit soft now. It is more of plateauing at this point of time. Now, whether going forward it will come down or not, we have to wait for some more time, because meanwhile, unfortunately, because of this geopolitical conflict, it has gone a little bit in the other direction. So again, two things are staying there. One is supply-demand situation, availability of ship, container, etc. And on the other side, the cost of fuel. There's a combination of both. So one has improved a bit with supply-demand availability in terms of container and ship. Unfortunately, the oil prices went haywire meanwhile. So to wait and watch. I think the worst situation, possibly it is gone. Hopefully it will not worsen from here.
Okay. Fair. Okay. Thank you, sir. I'm done with my question.
Thank you. The next question is from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello, am I audible?
Yes, go ahead.
Yeah, first of all, congratulations on a great set of results. I would just like to, I'm a bit new to the company, so I would just like to ask, how do we see the demand going further? And as you said, we might face some demand issues in the next quarter. So what should I assume as the base quarter and margins for current year? That's my first question.
From demand point of view, when you look at, I will say the last quarter demand was strong because war between Ukraine and Russia started, and there was constraint in supply from Russian side. In a way, it helped many companies, many industries. We are one of them. We got benefit out of that. But unfortunately, as the war gets prolonged, we are clearly seeing due to high oil cost, inflation is going up, interest rates are high. And now, unfortunately, that has started impacting the demand, overall demand of many products, including some of them. So, this quarter, we have a feeling that there will be some challenge from demand side. Having said that, I think India is a little better off. Not completely insulated, of course, from the global market, but a little better off with respect to the global market. In the opening remark, I mentioned that in US and Europe, inflation rate is as high as 9%, which is kind of record for them in so many years. So there are challenges definitely on the demand side. We need to find out solutions for that. And as I mentioned earlier also, the agility is the key to counter this kind of situation.
Correct, sir. So maybe the recent quarter might be a bit challenging. But overall for the full year, could we guide something? And my second question is, the new capacities will kick in completely next year, or how much time do we take in the trial, and what kind of additional revenue can we expect from our new capacities?
Okay. So So in terms of giving a guidance for this quarter, we will not prefer to do that because, we would rather prefer to tell you that we will face the challenges and we are confident that we will overcome those challenges. It's looking a bit challenging, but we are also sure that we'll be able to overcome that. So be rest assured on that, number one. Number two, on the new capacity of carbon black in Chennai, after it is commissioned, I guess it will take some time for stabilization of the plant. There will be some initial hiccups. I'm sure there will be some teething problem. And once it stabilizes, then we'll start trial with our customers, with our product. And since it is primarily a rubber black plant and we are regular suppliers to many big rubber companies across the globe, tire companies and other rubber consumers across the globe, it may not take much time for approval because our product is pretty well proven, well accepted across the globe in terms of quality. So I'm hopeful that within a quarter kind of time, we should be able to get approvals from most of the customers, 3 to 4 months time once it is stabilized. And then thereafter, a full-fledged commercial production can go on.
So, sir, as this plant commences on 31st December, so we'll be able to see revenue maybe flowing from FY24. Would that be a fair assumption? And what kind of an asset turn would we expect from this additional capacity?
Well, I think what you said is right. Possibly next financial year, we'll be seeing benefit out of this particular plant. So we should be seeing that benefit coming in. And since we are going up almost in terms of capacity, almost 30% capacity will be going up. So consequently, with the reflection in revenue as well as profitability at that point of time.
Okay. Thank you so much. That answers all my questions. Thank you so much, sir, and all the best.
Thank you.
Thank you.
The next question is from the line of Priya from Equitas Investments. Please proceed.
Yeah, my question is answered. Thank you.
Thank you.
Okay.
The next question is from the line of Abhijit Bora from Sharekhan by BNP Paribas. Please go ahead.
Yeah, good afternoon, sir, and congratulations on the good set of numbers. Sir, my question is that last quarter the commentary was quite optimistic in terms of both demand and also in terms of the margins because of the geopolitical issues. You mentioned that because of the supply concern, we would see a multi-year growth opportunity for Indian carbon black manufacturers. Now, I think that the commentary has been cautiously optimistic in terms of like Q2 may be challenging on inflation in the export markets especially. So like, are we seeing any reversal in overall demand environment and that can impact our utilization of the new capacity which is coming up? Or like still we remain confident that we may ramp up faster given capacity closures in China and also the concern in the Europe?
Well, you have rightly pointed out, last quarter commentary, of course, we are much more optimistic and positive because initially there was some silver lining and Russian supplies were getting impacted and therefore it was opportunity for others. And we have seen the reflection of that, right, in terms of numbers and etc. Now, unfortunately, the war is getting prolonged. And because of this inflation and other things, there are a bit of a concern, but I think we are quite optimistic, but cautious at the same time, as I mentioned. And the fundamental strategy in this scenario is basically agility. Right kind of strategy, extreme agility. So, this is the two things we feel we'll be able to sell through without any major problem. As regards the Chennai plant, it is going on track, absolutely on time. The progress is absolutely as per the timelines what we have decided. So we are not too concerned about that. And I think, generally, we always say that we don't get too disturbed or caught up with 1 quarter or 1 month, etc. What we talked about that time that we remain, and then we stick to that we remain optimistic on the long-term guidance. So one quarter here, one quarter there doesn't really matter. And even in this quarter also is quite optimistic. I'm not saying we're not optimistic, but as you rightly said, we are cautious at the same time. But our long-term guidance remains same, that we remain optimistic and we stay focused on our growth, fast growth.
Okay. And secondly, I think that you guided for 35,000, 40,000 kind of incremental volume in FY 23. Given the inflationary pressure, would we be able to achieve these incremental volume numbers? And for next year also, you guided for 50,000 incremental volume with 30% utilization on the new capacity. So, like, any concerns on these numbers, or these still remain to be factored into the assumption?
Yeah, I think, that what indication we had given that there will be some growth in terms of volume, we will stick to that. Barring some natural calamities might happen here and there. We have recently seen, just to share with you, very, very heavy rain in Gujarat. Very heavy rain in Gujarat, which led to flood-like situation. And we have two major plants in Gujarat, as all of you know, one in Mundra, one in Pali. And production got affected to some extent. Not majorly, but some impact was there. So, this kind of different things may happen. But by and large, we'll be on a growth journey for sure. Exact numbers, pluses and minuses may happen. But again, as I said, that we'll continue to grow.
Okay. And so lastly, on the margin front, we did close around 18,000 per ton of margins. So in Q2 and also for the full year, do we see these sustainable, though the demand is lower, but still the concern on the supply side remain? So, like, the lower demand can be offset by higher margins?
I think this was already discussed, and Mr. Rajgupta has already responded to this, that don't, take at one quarter particular margin as benchmark. And naturally, quarter one margins were a little higher, EBITDA margin was quite high per ton. So don't go by one quarter's margin, look at a long-term guidance. And I think we have already given a long-term guidance, and that remains same, that we'll be steadily growing on the margin side by virtue of better operation, more efficient operation, better portfolio, richer portfolio rather, our spread across the globe, international markets as well as domestic markets. It's a combination of everything. And that is a continuous process, a structural change. In between, there might be some spot opportunity for us in this quarter, that quarter. We will grab that opportunity. As an agile organization, we will definitely, grab that opportunity, but don't get carried away with those kind of, spot opportunities, and don't please take that as the benchmark in terms of profitability. But long-term guidance remains strong. We'll continue to grow in terms of profitability as well.
Okay. Last one, clarification on the margin front, that commodity margins were assuming at 10,000 or around that kind of level. You mentioned about like change in the product portfolio, efficiencies. So what rise in the share of the specialty segment? So what incremental margin on a sustainable basis we can build into our assumption? Can you guide on that part?
Just one clarification I must give you here. There is nothing called commodity in our business. The materials which goes through tire are also equally technically high-end products. It is highly engineered product, I would say. So, from our point of view as an organization, we really do not call them commodity grade. We rather call them a foundation grade. And then, of course, there are further value-added grades like performance chemical grade or specialty chemical grade for different applications. So it is more about application. We have got foundation grade for tire application. We have got performance grades and specialty grade for different applications like, say, plastic, paint, ink, batteries, all those kind of things. So there's nothing called commodity in our content. In our content, everything is equally important. Even so-called foundation grades also give us the same profit margin to us. As regards the possible guidance, I'm not sure whether we can give it. I request our CFO to give some idea on this.
Yeah, Abhijit, so as a policy, we don't give any guidance on numbers, but I would just give you an indication. So if you look at how our margin profile has changed in last 5 years block, over the previous 5 years block, I think in next 5 years, possibly there can be similar kind of change in our margin profile. Right? So that's how we see it.
Okay. Okay. Thank you, sir.
Thank you. The next question is from the line of Bharat Sheth from Quest Investment Advisors Private Limited. Please go ahead.
Hi, good afternoon, Mr. Roy and Raj, and congratulations.
Thank you.
Sir, would you just take us through our R&D approach and how do we see with the specialty world capacity increasing and how do we see new product and how are the new product vis-a-vis what earlier we were doing can start contributing and overall, and how is the profitability of the new product vis-a-vis old?
Okay. Typically for us, for example, about 10 years back, our portfolio was such that 95% of our product used to go to tire companies. So primarily, we are a raw material supplier for tire companies with those fundamental grades, which just I talked about, foundation grades, the fundamental grades, right? And then we thought it is important that we focus on our profitability improvement, and therefore there was the need to get into other segments like performance chemicals and specialty chemicals with those applications which I just mentioned. Now, that obviously needed a lot of focus on the R&D side. And first R&D center came up in India about 5 years back in Baroda. Second one came up about 2.5 years back in India. And as I mentioned, between the two R&D centers and technology functions, etc., we have roughly about 60 odd scientists and engineers and chemists there working on this. We have got 4 verticals in R&D. One vertical focuses on developing new products. It may be absolutely new product or it may be new for us, but cannot be new for the market per se. Maybe one of our competitors is making an advanced product we did not have in our portfolio, so therefore it is new for us.
Okay.
So one vertical is working on new products. One vertical is working on raw material is a big thing for us, and one vertical is working on raw material or oil engineering as we call it. So oil-related lot of research going on at our end for use of different oil, different types, different applications. And so all carbon blacks are not made from the same oil. There are different oils, different applications. So there is oil engineering is one vertical where the scientists are focusing on. Third critical is fundamental research where we are looking at absolutely new mechanism or new method of making carbon black. Something completely different, but these are pure play fundamental research. The fundamental research, as you can understand, will take its own time. I'll give one example. We are working on a plasma reaction technology. We are trying to use plasma reaction as a technology in our reactor to produce carbon black. Okay, so one focus area. So this is on the fundamental research side. And the fourth one is called post-production treatment. Now, once you produce carbon black, then you go for certain treatment of that carbon black to get certain properties, to achieve certain properties. So one particular vertical is working on post-treatment of carbon black or post-treatment of different chemicals. So this is the fourth vertical in R&D center. So these are the 4 verticals. That is how we are approaching the whole journey of R&D.
So how do we, sir, get what stage we are, getting the benefit and when do we expect certain, say one is the new product introduction timeline and what we introduced last 5 years and how do we see over the next 5 years as well as this oil engineering and plasma, what kind of a benefit overall company will have in?
Okay. I think you need to start the results of PCBL. We go back 10 years and you see the numbers today, you can see what is the impact of that. As I mentioned, 10 years back, it was about 95% product which used to go to tire companies. Currently, it is just about 64% which goes to tire companies. Balance 35% is between performance chemicals and specialty chemicals. In the specialty chemical, our share in the market was 0. As we speak, in the global market, we are the 4th largest player. fourth largest player with close to almost 10% of the global market share. And consequently, of course, the numbers are reflective of that. If you study the numbers of PCBL over a period of last 10 years, I'm sure you'll get the answer yourself.
How do we usually, your aspiration, say, from without, committing anything, but aspiration next 5 years?
I think Raj has already mentioned that our aspiration is, in the last 5 years, the kind of improvement we have seen in terms of margin, we should be seeing similar kind of margin improvement going forward in next 5 years. And that will happen because of many initiatives, and one major one is obviously diversification of product portfolio.
Okay. And this whole oil engineering journey, where do we are, and how do we see that?
I can't explain on phone what is the meaning of oil engineering and what is the journey. I think you have to come down and we can have a separate discussion on that.
Sure. And whenever we achieve something, we will come back and speak to you.
Okay. Thank you very much and all the best.
Thank you. The next question is from the line of Radha Agarwal from B&K Securities. Please go ahead.
Hi, am I audible?
Please proceed, ma'am. You are audible.
Thank you. Thank you for the opportunity, sir, and congratulations on the good set of numbers. So my question was on the CapEx side. So given that both the Chennai and the Mundra plant, the work in both the plants are expected to be completed by FY23. So, and also we have the second phase of Mundra plant capacity expansion. So, on the back of this, what could be the expected CapEx numbers for FY23 and 24 and 25?
23, possibly it will be between 900 crore to 1,000 crore. And based on the current CapEx pipeline, this FY24 will be around 200-250 crore more. But if we come up with any new greenfield or brownfield plants, then FY24 CapEx might increase.
Okay, and for FY25, if you can?
As of now, we don't have, visibility around 25 because that will depend on what kind of capacity we are pursuing. Our existing project will be through by end of FY24. Existing project.
Okay. So the numbers for FY24, does it contain the second phase of Mundra expansion or the numbers that you gave, 200 to 50 crores?
It does include second phase of Mundra.
Sorry, include, you said?
It does include second phase of Mundra. FY24 numbers does include second phase of Mundra.
Okay. Thank you. So, my next question is that...
Sorry to interrupt. I would request you to rejoin the queue as there are many other participants who are waiting for their turn.
Sure, no problem. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to answer the questions from all the participants, please limit your questions to one or two per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Santosh Kumar Keshri from Keshri Wealth. Please go ahead.
Hi, am I audible?
Please proceed.
Yeah. Thank you for giving me an opportunity. I had one question. We can see there is a global fall in automobile demand. Today, we got the news that UK there is a fall of 15% in the car demand. So, let us say that there is a recession in USA and it's little weak compared to what we are expecting today. So, how is it going to affect our product sales? That's first question. And second question is a very small one. If you can give me a split of your facility sales and non-facility sales.
Okay. So Santosh, there has been periods of demand softness, earlier also. 2020 was not a good year. I was talking about the period before COVID. But, that's where I think an organization's own capability comes into play. right? And our MD was talking about our laying down of infrastructure globally, setting up decanting stations, warehouses, getting our own supply chain. And therefore, our current dependence is not on any single geography. So even when we see softness in demand in some part of the world, we have the agility to move from one geography to another, to change our product portfolio so that if one type of product, the demand is getting impacted, then we can create new type of products and sell. Right? So I think that's about the agility of the company. And in some situation also, in part, we have been able to ensure higher capacity utilization. So we feel pretty confident that capacity utilization should not be a challenge. Of course, there will be periods when, the supply side or the demand situation is good. In those periods, the margin profile suddenly spikes up. In other periods, there is a impact on the other side. But I don't think capacity utilization is going to be much of a challenge for us. Our global market share is still very low, so I think we can increase our market share also. So would you like to add?
I just have one counter question for you. I'm expecting a global recession now.
Yeah, that's what the news is in the market, right? The economists are predicting global US recession, at least.
There's a fear. We're not sure whether it will lead to eventually a major recession like what we had seen in the year 2008, which got triggered because of the Lehman Brothers issue. But let's hope for the best. Why should we be so pessimistic about the whole thing? So let's think positive. And I think Raj has explained on the agility part, and let's hope for the best. And I think your second question was about the specialty share and all. Roughly about 55% is tire, and rest goes into performance chemicals and specialty chemicals.
Okay. Thank you so much.
Welcome.
Thank you. The next question is from the line of Nagraj Chandrasekhar from Emerge Capital. Please go ahead.
Hi, thank you. Just going through the commentary from Cabot, Orion, Tokai, it looks like nobody is interested in adding capacity on the tire side of the business. It's more Cabot talking about capacity for EV battery anodes and other specialty chemicals and so on and so forth, the others as well. You're also saying Russian capacity is out, isn't finding its way to any markets, and Chinese capacity is also not come back yet. Could you see a scenario where after, you're talking about $2,000 capex cost per ton all in for capacity in the West, including all environmental norms in place, whereas we built this Chennai plant for something like $700-800, I think, roughly ballpark per ton effective capacity. Could you see a scenario of prolonged shortness over a few years, especially if you see after two negative years, say 19 and 20, C-wise, okay growth in 21, positive demand growth for tire volumes in India in the next few years. Because here we're more of a new car driven market, whereas global market, even if you have a 10-20% decline in new car sales, most demand is mostly replacement driven. So the actual hit to carbon black demand won't be as steep. And with no capacity really getting added, you might not have that much slack room in the market, which is what a lot of these guys are also saying in their commentary. Just wanted to get your view on this.
See, we have a little bit of different perspective because, as you know, we are the leader in terms of Indian market. We are the largest player in Indian market, and we have certain responsibility. And the markets you talked about and the players you talked about, a lot of them are very active in the European market or US market. And those markets are actually extremely saturated today from the point of view of automobile as well as from the point of view of tire companies, therefore. Whereas the Indian market is not that mature, it is still evolving. It's a growing market. The economic situation is quite different in India vis-a-vis these countries and these geographies. So we do expect substantial growth of automobile in Indian market, and consequently, tire companies should also grow. And therefore, from Indian point of view, we feel that there will be scope for improvement, scope for growth, even for regular rubber plant. Having said that, in the beginning itself, I mentioned that as an organization, we started focusing on performance chemicals and specialty chemicals a few years back, 5-6 years back. and that led to a situation where today we stand about 65% goes to tire and the rest goes in performance and specialty chemicals. So that clearly shows our intention that we are focusing in that area as well. And at the same time, we do not want to vacate the growing tire market. We do not want to vacate that. And I think it is a responsibility as well. We are the largest player, we are the leader here in carbon black. Therefore, we can't afford to do that also. So our approach will be slightly different. This will be some of the names you have just taken. So that will be my answer to your question.
Got it. And supply isn't a big constraint on the tire supply globally, the tire carbon black supply.
I think constraint in the sense, the tires are getting manufactured, getting produced, so naturally they will be requiring carbon black. They will be requiring carbon black. And if you go back and look into a little more details of tires and automobile, these two segments of actually either they are flat or they are growing in Europe and USA. And these are actually growing in Asia. Asia is becoming the manufacturing hub, which includes obviously India on tire and automobile. So if you look at Asia perspective and India perspective, definitely there is an opportunity for growth in even tires. So therefore for us, in tire related raw materials and therefore it's carbon black. But I'm not saying at the same time that there is no scope for specialty. Of course there is. And that's how we have grown in the last 5 years. And as I said that we are, I think, fourth largest globally today in even specialty black. So it's a good news for us from both angles, from specialty as well as for tires.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, this will be the last question for today, which is from the line of Anubhav Sahu from Macro Research. Please go ahead.
Hello. Thanks for the opportunity. A couple of questions. One is, if you look at the domestic market, want you to understand how are we placed in terms of market share. I understand that import intensity from China has come down over the years, but if you exclude that factor of imports, so among domestic manufacturers, how have the market share been for us in the last few quarters?
Market share of us in the domestic market, are you saying that?
Yeah, in the domestic carbon black market. Yeah.
Domestic carbon black market.
Hello.
Is the question about our share of domestic carbon black market?
Yeah, our share of domestic carbon black market. Yeah, exactly. So, say for the horizon of last 2 years, how has it been? Like 2 years back, how was it and how is it now?
As I mentioned just a while back, that we are the largest player in Indian market today, and percentage share honestly varies from time to time because there are new players. Then at times we decide to export more, etc. But definitely we are steady at say 1/3 level and above. At 1/3 level and above.
Okay. So, on the this thing, capacity expansion, I understand that greenfield and brownfield, both the projects will come up chiefly from next fiscal. In the last one, you also pointed towards some efficiency gains for this fiscal year for increasing production volume. Are we on track for that? Are we, or given the demand situation, that is not the case right now?
Efficiency you're talking about?
Yeah, I mean, I think you were alluding to adding some capacity through efficiency gains around 30,000 tons or something in this fiscal.
Are you talking about this year we are adding 30,000 or something?
Yeah, for the fiscal.
There is no new capacity per se is coming. We are improving our efficiency and productivity, and we are expecting some additional volume coming in over last year, and therefore we are targeting this additional volume. But hopefully there is no major natural calamity, etc. Like as I mentioned, Gujarat we had some issue, heavy rain and flood-like situation. Other than that, we should be seeing some improvement, some upside on the volume side also in this year over last year.
Okay, and that range would be something around 30,000 tons. Is that the right figure I'm looking at?
I do not know what the calamities or situation will face going forward, so difficult to give an answer.
Okay.
But I think the intention is clear that we want to grow and grow fast.
Okay, got it. And sir, last call you also pointed towards you were waiting for some customer approval from the specialty grades, which could have added up something around 10,000 tons of sales volume for this fiscal. So any color on that, any views on that?
It is a continuous process because we are continuous basis. We are producing some products. We are coming out with newer products and going for approval, and it is on track. And our target remains. We talked about 10,000 tons large quantity of specialty this year, and our target remains. And we are on track as of today.
Okay. That's it from my side. Okay. Thanks a lot.
Thank you. The management have decided to take one more question, which is from the line of Saurabh Mehta from East Lane Capital. Please go ahead.
Yeah. So my question is slightly repetitive, but I want to know, sir, the EBITDA per ton, if you look at the last 4-5 quarters, it's been very volatile. So could you share what part of our volumes which we are selling in the spot market are really affecting or bringing this volatility into our EBITDA per ton annually?
So usually, Saurabh, we do about roughly 27-20% of our volumes in spot market, and that remains sensitive to demand supply situation. And if you look at our performance, don't look at on a quarterly basis, but if you look at year-on-year journey last 5-6 years, you will see that there is a gradual improvement in our margin profile. So periodical volatility will be there across all businesses, not only in our industry. So I think the whole idea is that whether we are improving our business structurally so that our margin profile also keeps on improving, and I think that's the guidance that we are given. So over a period of long time, maybe 4-5 years, one should look at how our margins have improved. I think that will be a good reflection of the real improvement in efficiency tax performance.
Largely 20% volumes reside into the performance chemical segment?
So this is both mixed. So tire, of course, tire largely remains large account for us, and there is a pricing formula. So mostly, yes, you can say it is mostly performance segment.
Sure. The second question is on specialty. Basically, we used to have this aspiration for high-end applications in the specialty segment. So, what is the progress there, and is there any EV battery application which few of our peers have developed? Is there something on which we are also working? If we can share some details about that.
Well, the progress in specialty has been very satisfactory, I would say. Whatever portfolio today we have developed in the last 6-7 years. We started with almost zero, and today slightly more than 9% of our volumes are coming from this segment. Right? And it is not only the volume, but also the number of grades that we have been able to develop. Currently, we have more than 45 grades, and now with our increased R&D bandwidth, we are also rolling out newer and newer products, more new products every year. Speaking about the grades which can cater to EV battery, our R&D team has been working on this, but R&D activities take time, and when the breakthrough happens, it just happens. So currently, it is under research and development. It can come. I would not comment on the timeline. If you are lucky, it can come up soon, or otherwise it might take a little time. But yes, we are, I think, in advanced stage. So,
made some significant progress in that area also. It is primarily lithium-ion battery for EV, and we are quite hopeful that we'll be able to crack it sooner than later. And that is kind of final frontier for us at this point of time, because we have already cracked, for example, grades relating to plastic, paint, ink, coating. We are kind of through with them. Having said that, we are continuously improving those areas also, enriching our portfolio further. And then currently, one team is working exclusively on this battery, lithium-ion battery thing, and we have made some significant progress. Very recently, I was in Belgium for a quick review, and then I realized
Got it. Thanks. The last question is on EBITDA per ton. What would be the gap between a tire and a specialty? And you used to have aspirations of few grades and specialty where we thought, very, very high margins could also be made, like upwards of 1 lakh per ton. So, is there any grade which we've been able to develop very high? And what's the difference between the tire grade and the specialty for EBITDA per ton?
I would not give you exact numbers, Saurabh. We don't publish separately, these numbers, but I'll just give you an indication. First of all, even the foundation grade margins have gone up, or the tire business margins have also gone up in last 4-5 years, and that is because these are not the same grades that we are selling to tire companies. There has been a lot of customization, a lot of new grade rollouts, and we have even discarded some of the old grades. So when the tire portfolio has changed for better, and the margin profiling tire segment consequently has improved significantly. As we speak currently, we make about 2x in specialty business on the margin side when we compare it with the tire portfolio margin.
And the performance would be how much?
Performance is about 20-25% more than tire.
25%. Okay. Thanks a lot, and congratulations on the very good set of numbers. Thank you.
Thank you. As that was the last question for today, on behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your line.